Good day everyone, hope you're well. Today we are going to discuss Accounting 101. It's going to be an introduction for grade 8 learners and revision for grade 9 and upwards. Right, so this is going to be video 1. I'm going to make a few of these videos. Right, so accounting terminology. First of all, we need to know the definitions of a bunch of accounts before we can continue to doing accounting. There are three types of categories of accounts: assets, owner's equity, and liabilities. Assets is the possessions of the business. It is owned by the business. Cash will be received if it is sold by the business at a later stage. Owner's equity, it is the owner's interest in the business. Liabilities represent what money the business owes to outsiders, to suppliers and banks and financial institutions where we borrowed money. Right, so first group of accounts, assets. You get two main groups of assets: non-current or tangible assets and current assets, and the main difference is the time frame associated with each. Non-current assets is assets that you keep for a period longer than 12 months, and current assets is shorter than 12 months. Right, so non-current assets. It's bought by the business to generate income, not bought for resale, lasts a long time, it is permanent in nature. And then a few examples: land and buildings, equipment, vehicles. And then current assets: increases or decreases in value, it's temporary in nature, used to pay expenses. Right, so trading stock, you will keep it in your business, and as soon as you buy it, you will try and sell it as fast as possible. Therefore, the amount or the value of your trading stock will fluctuate a lot within the next 12 months. Therefore, it is current. Debtors control, this is money being owed to the business by clients. Right, so 1 month more people will buy on credit, the next month some people will settle their debt. So it's going to fluctuate a lot as well. Your bank balance, 1 month you will have a lot of money in the bank, next month not as much. Cash float is the money where you get change for your customers, so that will fluctuate all the time as well. And then petty cash, it's money that you keep in your business whenever you need cash to quickly go and buy something, so that will fluctuate all the time as well. Back to non-current assets, land and buildings, equipment and vehicles. You can see that all three of those examples are assets that you tend to keep for a period longer than 12 months. In other words, your intention is to keep it longer than 12 months, 1 year. Right, so owner's equity. You get two types of owner's equity: capital and drawings. Capital is when the owner puts money into the business, and drawings is when the owner takes money out of the business. So in other words, capital will have a positive influence on the business's owner's equity, and drawings will have a negative influence on the owner's equity of the business. Right, so owner's equity. The following two types of accounts influence owner's equity. It's very, very important to remember that income and expenses both are separately classified as income and expenses, but it will influence owner's equity. It's not classified as owner's equity. All right, let's have a look at income. Income is money generated by the business. It increases profits made by the business, increases owner's equity. So income will have a positive influence on your owner's equity. And then current income is an example: sales, rent income, interest income, commission income. All of that is money received, and it will have a positive influence on your owner's equity. Right, then expenses. Expenses are money never recovered. In other words, you spend it, but you're not going to recover it. Needed to run the business, decreases profits made by the business, decreases owner's equity. So it will have a negative influence on owner's equity, the opposite influence that income will have. Examples will be salaries, wages, rent expense, telephone, stationery, water and electricity, consumables. All of this is money that you pay and it expenses of the business. Therefore, it will be money flowing out of your business and it will have a negative influence on your owner's equity. Just be careful. A lot of people get confused with salaries and wages. This is money that you pay. You are paying salaries and you are paying wages. Remember, we are doing the books of a business, and a business can't receive salaries and wages. They pay salaries and wages. A business receives sales and they receive current income for providing services. Right. If your income exceeds your expenses, you will make a profit. And if your expenses exceeds your income, you will make a loss. Liabilities, your third group of accounts. It is divided into two main groups of liabilities: non-current liabilities and current liabilities. Once again, the only difference is really the term. Right, so money repayable over several years with interest. Non-current liabilities, it is liabilities that you are going to have for longer than 12 months. And current liabilities is liabilities that you're going to have for a period shorter than 12 months. Right, so a mortgage loan, that's normally a loan to buy property. And property loans, it normally tends to be a period over 20 years. Much longer than 12 months, right? So that's why it is a non-current liability. And then a car loan, an average car loan is normally 6 years, also much longer than 12 months or 1 year, and that is why it's classified as a non-current liability. Then current liabilities, money repayable within a short period of time, 1 year, shorter than 12 months. Creditors control, this is if we buy stuff from suppliers, they will be known as creditors control in our books, and we will owe them money. So 1 month we will buy a lot of stuff on credit, and the next month we will repay some of those debts. So the value of our creditors control will fluctuate a lot within the next 12 months, and that is why it is known as a current liability. Overdraft is basically a normal check account at the bank that can go into a negative balance. In other words, you can spend more money than what you have in the bank. It is basically a normal bank account with a credit facility. In other words, it can be used as a credit card. You can spend more than what you have in the bank. So if you spend more money than what you have in the bank, you will owe the bank money, and then the next month you will receive some money, and then it will be positive again. Or you will just owe the bank less money. Point being, it will fluctuate in value a lot of times within the next 12 months, and therefore it is classified as a current liability. I hope this makes sense and that it helped you. Watch out for video 2.